Hello everyone, my name is Amit. Today I'm going to share some lessons from Howard Marks, who is one of my heroes and a legendary investor. These ideas have also shaped how his firm, the Oaktree Capital Management, sees investing. Let's get right to it. It is counterintuitive because if a bridge fails, we assume that the engineer likely made a mistake. But investing is not like physics. There's a lot of randomness. Someone can make a bad decision and still make money. Someone can make a good decision and still lose money. Buying a risky stock and doubling it up does not necessarily mean that you're a good investor. You might just have been lucky. Many investors end up being right for the wrong reasons. Even if something is most likely to happen, many other things can happen instead. When I'm talking about forecasting, I am mostly referring to macro forecasting. There are two types of forecasters, those who don't know and those who don't know they don't know. Most forecasts are just extrapolation of recent trends, and extrapolations are right a lot of the times. But the problem is, if everyone already believes it, it's priced in and you don't end up making any money. To make money, you have to make deviant forecasting, and it's extremely hard. And what is even harder is making those predictions consistently. Think of the game tennis. Many players win by hitting winning shots, while others simply win by not making mistakes. Investing can be a loser's game. If you can't consistently hit winners, avoid making big mistakes. So it's often better to avoid a bad investment than chase a perfect one. Many people think that success comes from buying great assets. That's not true. The real key is buying things for less than what they're worth. For example, if you buy a great company but at a very high price, you can still lose money. But an average company bought at a very cheap price can still make money. Most often, your return depends on the price you pay than the quality of your pick. Volatility means prices move up and down. That's not the real risk. Real risk is the chance of losing money. The hard part is, risk cannot be measured. Not before, not even after. For example, if you made money, was it a safe decision or was it a risky one? You can never be sure. There are different kinds of risk. Missing opportunities is also a risk. Taking too little risk can hurt you as much as taking too much. Let's try to identify one of the biggest mistakes in investing. Consider these two situations. Which one is worse? Buying a stock at a high and seeing a drop, or selling at the low and missing out on recovery? The second one is clearly worse. Let's try to understand why. Markets usually recover over time. If you hold, you can recover and grow. But if you sell at the bottom, you lock in your loss and miss the comeback. Selling at the bottom is one of the biggest mistakes an investor can make. These were some of the timeless lessons from Howard Marks. If you enjoyed this video, please do like, share and subscribe, and stay tuned for more such insightful videos. Thank you for watching. Bye for now.